Hello and welcome to MarketsFlow's Webcast 10.0, our portfolio performance for the week ending July the 5th, 2019. I'm joined by Adam. Adam, how are you?
I'm very well, thanks, Tom. It's good to be back here another Friday at 6 to give our regular update.
Indeed, Adam. Okay, before we get started, MarketsFlow is an FCA authorized investment manager. We're also SEC authorized RIA. Your deposits are protected by the FSCS for up to 85,000. Just to run through the disclosure, your capital is at risk. Any financial performance figures refer to the past, and that past performance is not a reliable indicator or forms guarantee for the future results. So with that, let's get to the interesting question. How did our portfolios perform for this week, Adam?
Well, up to Wednesday, before the 4th of July holiday, we had performance numbers of, for the high growth portfolio, up 0.5%, for the growth portfolio, up 0.8%, and for the ISA, up 0.38%.
Thank you, Adam. Did I hear that correct? The high growth underperformed the growth portfolio.
Yes, that's right. But they are built on different portfolio constructs, although they overlap to some extent. High growth is designed to take on more risk, which from time to time will cause it to underperform the growth portfolio, but it's not something to ring alarm bells.
Indeed, and I guess that goes both ways. It underperforms and it overperforms
as time over the passage of months. These things even out.
Indeed, thank you. And so, what about the allocations within the portfolio?
Well, our signals were modestly upbeat again this week and pretty stable. So, reflecting that, actual allocation in portfolios is fairly high for much of the week. And also we were quite active in trading. It was an interesting market that shows the same phenomenon we've been seeing quite a lot lately, and I think we've mentioned in some of these sessions before, which is a market that doesn't move very aggressively on the surface or even very much, on aggregate, but beneath that aggregate, plenty of dispersion between the performance of different stocks and between different sectors. So very much a stock picker's market. There's more opportunity in that sense. If anything, this characteristic that we're talking about has been getting even stronger in the last couple of weeks. So with correlation between stocks fairly low, when we sell options, it also allows us to collect more premium than you'd expect if you simply looked at the market level implied volatility.
Indeed. So how did we risk manage our way through this week's market developments?
Well, the week at the index level, S&P 500, for example, or you could pick any of the others and have a similar story. We saw small positive moves each day from Monday to Wednesday, albeit with some significant differences within each day, where the market would take a distinct direction for a little while, only to reverse it later the same day. So in that sense, some intraday timing opportunity. And as we've already mentioned a minute ago, Thursday was closed for Independence Day holiday, and today is a modestly down day for markets, but it's only modestly so, and that's as at now, a few hours to go. Our indicators foresaw a modestly, or at least actually they implied a modestly upward week, and they didn't change much, meaning that we didn't have to be very active or very busy changing things from day to day, but we were conscious of needing to get the timing right, because at the individual stock level, there was quite a decent amount of movement going on from time to time. So it would make quite a difference if you were to execute the same trade at 1 p.m. instead of 2 p.m. With those intraday changes. And I think we came through that fairly well.
Yeah, thank you for that. So how are things looking so far and ending the week?
Well, today so far, what are we, a bit more than halfway through today. It's a negative day so far for the S&P. It's slightly less so since Europe closed. But if nothing changes from here, we have the S&P down today, but still modestly up on a week. However, from the point of view of our portfolios, today seems to be a positive day so far. So that, hopefully when we close today, those numbers that I told you at the very beginning of our conversation here today for the three portfolios, we'll hopefully be adding a little bit more onto those. So a positive week.
Sounds very good. So we'll have a good positive week after the previous week. And as for today, it was a non-farms payroll day.
Yes, absolutely. The first Friday of the month. And this particular report, non-farms, was generally perceived as a strong jobs report. Perhaps curbing hopes for any near-term rate cuts from the Fed. And so in this often perverse world of good news being bad news and vice versa, because a decent economy means a less supportive Fed, this possibly dampens spirits in the equity market. But these developments are so open to subjective interpretation that, that if your investment strategy is built largely on the basis of these, you're very exposed to the whims of 1 month's report and which could, of course, easily be revised in the next couple of months, and the market's fickle interpretation of each of these reports. Plus, it's important not to forget that the labour market numbers being reported here, these tend to be a lagging indicator of where the economy's actually been anyway. So we try not to put too much focus on it.
Well put, Adam. Thank you. And on that very valid point, let's wrap this up. Have a very good weekend ahead, and we'll be back in a week's time. Thank you for tuning in. Bye-bye.